This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The previous chapters have focused on valuing a target company. So whether that's going through there and using the dividend valuation model, applying the free cash flows or free cash flows to equity, price earnings, was it net assets, and part of net assets we also went through as well and looked at your calculated intangible values, didn't we? This chapter looks firstly at what then happens after acquisition. So what issues can arise, how do we deal with them, what happens if we've acquired a business that has large amounts of debt, what do we do with that debt, and then also as well we start to go through there and think about if we're putting a bid in to acquire a target, so we're looking at things from a predator perspective, how do we finance or how do we structure that offer? Do we offer cash? Do we offer a share for share exchange? Do we offer a mixture of cash and shares? Or also is there contingent consideration, or at this level it's referred to as an earn-out agreement? So we'll need to look at each of those different scenarios. So if we look at the first bit, I suppose we're jumping around within the notes, but I just wanted to get it out of the way. It's very small, there's not a lot there. Is looking at your post-acquisition aspects. So the target entity debt. So if you bought a company, it has debt within it, there's two things that you can do. It's very simple, very straightforward, and you will go with the cheapest and more beneficial option. One is that you can repay off the debt. Okay, it's gone. That will save you the interest into the future, but you've got to have the cash available to be able to pay off that debt. So it can be done, but it's quite a cash consuming exercise. The other option is to go through there and refinance it, which means that you take one form of debt, convert it into the other. That might therefore make it a bit cheaper, but over a longer period of time. So therefore means it's easier to pay it off over that prolonged period of time. But one of the issues that you have whenever you go through there and acquire a business that has debt in, is this, it's referred to as the co-insurance issue, in the when you make an acquisition, it's usually the target shareholders who gain at the detriment of the predator's shareholders. The predator's shareholders normally have to give a little bit to be able to take control of that target company. And it's then just a little bit unfair because the shareholders of the predator company lose out, usually then as well at the benefit of the debt holders, because the debt holders are more than likely to get their debt paid once the business has been taken over. There's maybe more cash within the business, it's better managed. So, you know, the equity holders are losing out at the expense of the debt holder, which, you know, is that necessarily fair? Okay, but that's something that we can consider another time. Okay, but the key bit is that when you're looking to address the debt issue, we either repay it or we refinance it, and we go with whatever is the cheaper, more cash friendly option. The post-transaction issues effectively is that it will fail. The acquisition does not work, and therefore if it doesn't work, we don't generate the synergies that we were expecting, and if we don't generate the synergies, then therefore we don't generate the value, do we? And therefore that acquisition is even less worthwhile from a predator shareholder perspective. So we need to ensure from a predator shareholder perspective that the acquisition is going to work. Okay, the reasons why it would not work is there might be opposition to the takeover, and therefore that opposition might go through there and cause resentment amongst your customers. Your customers might go through there and move elsewhere. It could be there that on takeover of the predator company that the management aren't able to run that business as well as they were expecting. You know, especially if we've diversified into a non-core aspect of business, can we apply our knowledge to that non-core aspect? You would hope that we will be able to, but it might not work as well as what we were expecting, and then because of that, there are then additional costs as we need to go through and rectify any errors that are made. And if there are additional costs, that reduces the cash flow, and that therefore goes through and reduces the value of the business, doesn't it? So it's important that the integration process is managed well. So that means communicating it to the employees so that they know what the overall aims and the outcomes are, reassuring them maybe about their jobs, because obviously if there is a takeover, everybody is fearful of losing their jobs, and if they are, they might not work as efficiently as what they would be expected to, because they're thinking, well, I'm just going to go through there and take redundancy and leave. So you've really got to manage it well. Okay, if you manage it well, it will be successful. Don't forget, there are other external factors that sometimes might not be within the realms of your control. If you went through and were expanding when all of a sudden there was then the global recession, then that would be quite difficult to go through there, wouldn't it? And be able to update and manage the scenario to the best of your ability. There were sort of circumstances that were beyond your control. Okay. The collapse of the financial markets as well, then making it very difficult for businesses to raise finance. Okay, if you've just acquired an entity and then struggled to raise further finance, then that would have gone through there as well and caused post-transaction issues. There's not a set list of things that you need to learn. It's just making sure that you have an awareness of what a business needs to do to ensure that things are successful. If we just then take a step back and start thinking about how we set up the bid, okay, we can go through there. Is it with cash, shares, and earn-out arrangements? Earn-out arrangements to you and I is your contingent consideration. Okay. And we need to go through there and be able to think about whether it's better for cash, whether it's better for shares, or whether it's better as a contingent consideration. Again, don't forget, it's usually as a mixture of each, isn't it? Okay. If you think about the acquisition of WhatsApp by Facebook, I think that was the around about, memory serves me right, where are my numbers? Yeah, $19 billion. Wow, $19 billion. Of which about 4 or 5 billion was for cash. Obviously, 19 billion is a lot of cash to find. The remaining 14 billion was there as issuing shares, as a share for share exchange. Okay. The key bit is that when you acquire a business with cash, you need to find the cash. So you might need to borrow, which will increase the levels of debt and will impact the level of gearing and might then make future borrowing more difficult to achieve. But at least you know the exact amount that you are going to pay. If we think about cash and shares, the share price then may change, and that then may change the overall value of the acquisition. Okay, so from a target perspective, the shares are good because you still have an involvement within the business, but it will change the value of the offer. Okay, with cash, it's a certain sum. You know how much you're getting, and also then that might be beneficial because then you will know the amount that you are then going to pay on disposal of your shares in terms of tax. Okay. The other situation, I suppose, is then your share for share exchange. From a target perspective, that's beneficial because it means you have an ongoing interest within the business. I think the major shareholder of WhatsApp was then appointed to the board of directors of Facebook. Okay. And with the shares, they also had a vested interest. However, just be careful with the share for share exchange. Depending upon how the shares are issued, you need to be careful that you don't set it up so that you ultimately lose control. There could be the situation where it's done deliberately in the form of a reverse takeover, but that's beyond the syllabus at this point in time. But the key bit, obviously, with a share for share exchange, there's no cash that is raised from the predator perspective. Okay, raised. There's no cash from the target's perspective that they receive. They just receive a share in exchange for their old share. Again, what you need to be careful of then as well with regards to a share for share exchange is that from the target's perspective, there might then be the opportunity to defer any capital gains that you have made on disposal of your old shareholding, which may therefore be beneficial and save you money in the future. Okay. Share for share exchanges are usually used on top of a cash offer as well. It's very rare that you just see a pure cash offer. It's usually cash and shares, particularly in the modern day when there's a lot of acquisitions of these tech companies. These tech companies that are acquiring other tech companies, neither of them have huge cash surpluses. Okay, there's not piles and piles of cash floating around. So to be able to make the acquisition, they use some cash that they can get from the business or via borrowing, and then issue shares in their business in exchange for shares in the predator business or in the target business. Okay, and then what you've got is it there your earn-out arrangements. An earn-out arrangement is contingent consideration whereby you will either pay more cash or issue more shares depending on the future performance of the target company. If the target company performs well over a period of time, then you will therefore either issue more shares to the target shareholders or pay them more cash. And the reason why that's beneficial is because it sort of helps you with the post-transaction issue by ensuring that the managers who are likely to be shareholders themselves will run the business in the best interest of the overall business as opposed to pursuing their own individual aims. So it gets around that agency problem of directors running the business in a different way of the shareholders. Because the directors own some shares, they want to make sure that everything works and therefore will run the business in an appropriate manner that ensures that the business is successful. Okay, there you go. There isn't a huge amount to it, and I will leave you to have a read of the textbook, play around with the questions, and if you've got any questions, feel free to ask on the forum.